Sinead, a lot of people, when they become a parent for the first time, have the intention, at least, of saving the child benefit for a child's education or some kind of big ticket item down the line. But it doesn't always go that way, does it?
I think it rarely goes that way, Katie. Like most parents, I couldn't afford to put away children's allowance from the get-go because babies are so expensive and you end up having it more as an aspiration than a reality. But there are lots of people who do manage to put away at least some of it and then certain people who think, do you know what, this is earmarked for my baby, my child, education. It's so expensive, certainly the college years, so I'm going to make a concerted effort to put it away for the full 18 years. So everybody's different. And, some families literally couldn't put food on the table without children's benefit. And then there are others for whom it's not necessary. Because remember, it's probably the only benefit that we have that is a universal payment. It's not means tested. Everybody gets it. It's €140 a month and it comes to you regardless of your circumstances.
Tell me about your own experience with it. So you weren't able to afford it with your first child, but then you were able to put a bit of it away.
Yeah, I mean, look, I suppose as each extra child comes along, in theory anyway, it gets a little bit cheaper. You can recycle the clothes and, you're making meals for only a slightly bigger family. So, yes, I think like lots of people, there's 650,000 families who get child benefit. And I spent every cent of it on babies, on equipment and clothing and all of that. And then the school years and then after school activities and all the stuff that goes into parenting. By the time the second came round, things were a little easier, a little freer, and I tried to make a concerted effort to put it away every month for both their benefits, by the way, but that was just the second one. And then you're kind of looking for an instrument in which to save it, because you do have a good bit of time. It's not something you're going to need next summer or in 2 years' time. You can afford to take a little bit of an investment decision rather than a savings one, and it was earmarked and used for college fees.
Okay. So Owen McGee, who writes for us time and time again in his columns, he says, if the money isn't needed in the next 5 years, it doesn't belong in a deposit account, with, not in a credit union, not in an unpost account, not in a bank. It has to be invested. Would you agree with that?
I would. I even 5, I'd go further than Owen. I'd say, if it's not needed in the next, say, 6 to 7 years, because anything before that, you need to keep it reasonably liquid. You need to keep it safe, first and foremost. And if it's anything that we psychologically perceive linked to our children, our first and foremost reaction is to be very cautious and conservative with it. So there's 2 things I'd say about that. The first is, yes, if you don't need it liquid for 6 or 7 years, by all means invest it. You're not going to get any kind of a return on a deposit account over any period at the moment, meaningfully. But if you're going to need it in the next 4 or 5 years, well then, if you've invested it away, you could experience a downturn in the market. You'd have fees and charges coming off it, and keeping it in a deposit account is just the safest thing to do with it. And really, I don't get too worried about where it goes, as long as it's safe and secure in a bank. And the top tip for me is to not put it in the bank where you have your current account or in the institution, because it becomes very easy then to dip into it, or to justify dipping into it, or to say, well, it's really for the kids, but actually I need my weekend away because of the kids and all that. And it's gone before you know it. So out of sight, out of mind. And that means you can set up a direct debit, a standing order to get it out of your account when it comes in, and then it can build up elsewhere.
Okay. How did you invest yours?
Well, at the time, there was a curious type of government savings scheme called the SSIA. It was like a state savings scheme. It was a terrible idea, but everybody loved it. And people put their money into it every single month, and then the government topped it up. A bit like they'll do now with auto-enrolment on pensions or with pensions in general. Of course, it was hugely inflationary, but it was at a time when the government really needed us to save money and put money away. So to my recollection, my kids are very old now, but to my recollection, that's where it went.
Okay, excellent timing. But so there's no SSIA these days. So where would one put it if they wanted to invest it?
Okay, well, there's a couple of options. I mean, look, if you're going to put it on deposit, just leave it sitting in a deposit account in your bank. You'll be putting away, until your child is 18, from birth, you'll be putting away about €30,000. Now, bear in mind, the child benefit amount itself has not changed in a decade. So, as in it hasn't even kept pace with inflation. So, anyone with a 10-year-old is effectively getting a lot less now than they would have got when that child was a baby. So if you just stick it in a bank and forget about it, it'll be worth 30,000. But in 18 years' time, 30,000 isn't going to buy you nearly what 30,000 will buy you now. So if you have a little bit more time and you're getting it from an infant right up to 18, or even for 10 years, you can put it in any kind of an investment unit-linked product. Now, these are typically sold by life insurance companies. You can put it in a very safe type of managed portfolio, which has a basket of goods like equities, stocks and shares and property and cash and bonds and all that kind of thing. You don't need to worry about it. They have investment managers to do it. And if you put in €140 a month, which is the child benefit amount, at a modest growth rate, about 5.5% a year, then when they turn 18 and are ready for college, you'll have not 30,000, you'll have put in 30,000, but you'll have about 41,500. After tax.
After tax.
Yeah.
Okay.
So, and that, it's very hard to know, kind of be fixed on growth rates, but that would be a great period of time that you won't have to worry about it. In other words, it's enough time to knock out the ups and downs of a managed fund over that period of time. And that's why you wouldn't want to be doing that for 5 years, but you can certainly do it for 10, 15 or 18.
Yeah. Now, the big fear is that when your child gets to 18, the market is in decline. So how do you, I don't know, de-risk almost in the years leading up to that?
Yeah, well, in pensions, we call this lifestyling.
Okay.
And it's a deliberate mechanism, because you don't want to be arriving at 55 or 60 with this great big fund, and then there's a market crash and you lose everything, okay? So most pension fund companies or insurance companies will build in a lifestyling element. So every year for the last 5 years, 20% is taken out of that fund and put into something super safe like cash. Okay, so it's kind of safety first approach. So you can do that yourself. So as your child is reaching secondary school, maybe after the junior cert, that would be a good time to check in with your investment advisor or your insurance broker and say, look, in case something can happen, can we move it into a slightly safer managed fund? And there's no problem doing that. It's very, very simple. It's simply a letter to the investment company to say, can you move it from, usually these are risked 1 to 5. 5 being the riskiest, 1 being super safe. Can you move it from a 4 to a 3 and then a 3 to a 2 if you're a little bit worried about it? And that basket of assets would be more cautious and more conservative at level 2 than it would have been at level 5.
Okay. So by the same token, is there anything to be said for going high risk at the very beginning of the investment?
Listen, if you have 18 years, there's absolutely no reason that you shouldn't. In fact, you would be actively encouraged to do that. Now, any good financial advisor, the first thing they're going to do when you walk in, Katie, is to do a risk profile with you. Okay, because there's no point in trying to push somebody who's a naturally very safe, conservative person into, putting it on the 320 at Kempton. You're not going to, that's not fair. And it's not, or here's a crypto fund to stick it in.
Stick it in Doge.
Yeah, exactly. So you have to assess what kind of a person you are. But moreover, they're going to start with a question like, what do you want to happen in the future? How is your life? What do you want it to look like? What do you want for this baby? What do you see happening in the future? And then they'll work back from there and work out the time, the money you have, and your approach to whatever risk you want to take.
Now, you're going to come out with a lot more, right, if you put in a lump sum at the beginning?
Well, not necessarily, because the institutions that take in money from you, that save money, they much prefer regular savers to a lump sum investor, okay? The banks certainly do. So somebody who's regularly putting by money can often get a better rate than somebody who's putting in a lump sum. So if you look at our main banks, so Bank of Ireland has a product called Super Saver, AIB has an online saver, and EBS Family Saver, okay? Now they're all offering 3% AER, 3% a year for regular savings products. Now, you won't get that for a lump sum. You know, now they've limits. So, for instance, Bank of Ireland's is the best. So, up to €30,000 in regular savings. That's ideal for children's allowance, and they'll give you 3% on that. So that's quite generous. State savings. So these are, the NTMA products that we have. You'd know them maybe as prize bonds or certificates and bonds that you buy from the post office. They have a great product specifically designed for child benefit, and it's called Childcare Plus. And the way that works is because they understand that you're going to need that money on a rolling basis. You don't need the whole lump sum out all at the same time. So they have a product which runs over 6 years. So you put in the €140 for year one, every single month for a year, and then that stops and rolls over for the next 5 years. Next year you do the same. So you end up with these like micro-stacked accounts, which they look after. They do all of that. Now, on that, they're prepared to offer 1.75 AER, but it's tax-free. Whereas in the bank product, you pay dirt tax. So that's effectively 10% interest on the total amount if you do the maths on it. But you'll have a rolling capital dropping into your account every year after year 6. And you can reinvest it or you can spend it depending on your needs at that time. And that's fully state guaranteed.
Yeah. So, you mentioned deposit accounts there. Would this be better for somebody who's a little bit later who's coming on board with this plan a little bit later in life? Because surely if you've got that full 18 years, you should be investing.
Indeed. And of course, any parent will tell you that, the baby years and the primary school years seem to go quite fast. The minute they get into secondary school, they're gone in the blink of an eye. So a lot of people only start thinking of, oh my goodness, my child may be going to college when they're going into secondary school, and they start talking about exams and points and CAOs and all that, and you think, crikey, I need to start saving some money for this. So it might only be when they're 12 that you suddenly realise you need to put away funds because college is expensive. And this is an ideal product for that then, because it's for 6 years and then you get it year by year for 4 years of college. But any account that is going to keep it safe and give you some kind of return. And don't forget, Katie, now there are products in European banks that a lot of people source at the moment, because interest rates in Ireland, notwithstanding the ones I mentioned there, which are quite good, interest rates in Europe can be that little bit better. And the portal, probably the safest portal for that at the moment is called Raisin Bank. It's raisin.ie, and they are like a broker site for all those state guaranteed, deposit guaranteed fixed term savings plans. Now, most of those would attract lump sums rather than regular savings. So if you're somebody who has a lump sum and wants to put it by for 5 or 6 or something years, then that might be a great option.
And this is also an option, I guess, for people who have no appetite for risk.
Yes, definitely. So these are deposit accounts. That's what you're looking for. And I would just be careful when you have an account on something like, let's say, Revolut, which is great, very convenient, and it's very easy to set up accounts and vaults or pockets or whatever they call them now. That's a super idea. Just bear in mind, it's very easy to inadvertently set up an investment account rather than a savings account. And an investment account carries risk. It's clearly laid out, but it can just be very difficult digitally just to click the right bit. And I know people who have inadvertently said they want to invest the money, whereas what they actually wanted to do was to save the money. Okay.
Back to the lump sum question, and you said no, it's consistent savings is better than a lump sum. But specifically with investing, if you're investing your 140 a month over 18 years, I believe the compound interest would really speed up if you started with a sizable enough lump sum.
Well, like anything, money makes money.
Yeah.
So the more you start with, the more you're going to have
Yes.
at the other end. And it can be a nice idea when a baby is born, a little newborn into the family. Sometimes grandparents want to give them a little gift or a good start in life, or, set up some money for them. And I think that's a charming idea. Only, of course, if grandparents can afford it, and it's easy to do. And they can gift a grandchild anything they like, obviously, if they have it put away. But revenue allow you to gift a small amount of money. They say up to €3,000 every single year. And it won't impinge in the future on things like inheritance or tax or anything like that. So you could have Nana and Grandad both gifting €3,000 to the baby every single year, tax-free, and put it in an account for that baby, and then it'll be there at the end when they head into college land.
And then it's the child's money at 18, so
And
they had better spend it on college.
Well, of course, once you gift money, and listen, I've seen this happen. It sounds funny. You gift money to an adult when they're 18. It is their money. Yeah. It doesn't come with T's and C's. An adult is receiving this money. So what you might want to do is say, why don't I pay for your college fees by sending it directly to the university? If you are worried about, your grandchild or your child heading straight to
Bally.
the bar or Bali. Exactly.
Yeah. So tell me about the conversations that couples should have before they get into this into the saving, before child benefit starts coming to them. Surely that you have to have a good plan laid out.
Yeah, probably way before that. Because I think that when you're we're getting married and having children much later now than maybe we would have had 40 or 50 years ago, okay? Some people are coming to a marriage or relationship with separate properties, separate incomes, and separate attitudes to money. And if you're married to somebody who's a spendthrift, who literally cannot it's like water through their hands, and you're a super cautious saver, then you are going to run into marital problems long before you get to the rows about anything else. So you do have to have those conversations. I think it's a really good idea. And to sit down and say, what are our joint values and goals? And especially when kids come along, because now you have a shared responsibility, an expensive one, and how are you going to manage that? So doing it on the fly might be the way for some people. Oh, when the bills arrive, we'll just pay it. Whereas somebody else might say, look, I prefer to plan in advance. I like to know that their medical fees, their dentists, their school, their uniforms, their college, their books, they're all paid for, that we have a plan and a structure. So it's a great, actually, opportunity to sit down. And once you're over the excitement of welcoming a newborn and all that goes with that, to sit down and say, how are we financially going to bring up this baby?
And I would imagine if you're not relying on it from the outset, if you don't absorb it into your monthly income, it's a lot easier just to put away, out of sight, out of mind.
Yeah, I mean, if you're managing well and you're paying your mortgage and you're paying your bills and you're able to afford the baby that you've just had, and you don't absolutely need the child benefit, you're going to get it anyway. So it's a great idea when you're registering your baby's birth, because that's what's needed to get the child benefit from the Department of Social Protection, to say, look, let's have a plan around this. So before we start getting it into our account, it's very hard to give away money once you're enjoying receiving it. So if you've decided, look, we're doing okay, we don't absolutely need this money now, it is for baby Johnny, let's put it away now and have a plan to do that. A little bit of research online. It doesn't matter initially where you put it, because you've enough going on with taking a baby home and you've enough to do in there. Stick it in a bank account, and maybe in a few months' time say, now, what are we going to do with this? What do we want it for would always be the first question. Because while savings of themselves is a good idea, if savings are not earmarked and goal set, there's really no point to them. That's when they're going to disappear, because you'll dip into them and use them for all sorts of things. So I like to set up savings accounts, by naming them. So I'm talking about money you're going to need in the next number of years. So if you want to change your car, for instance, you set up a savings account, and instead of calling it account number 1, 2, 3, 4, 5, you call it my new car, or, Aoife's college fees. And banks will allow you to do that online, name the account. And it just creates a barrier for you to kind of save you from yourself if you're inclined to go and steal your own money back. If it's marked Aoife's college fees, you'll be less inclined to dip into it for a new pair of shoes. perhaps, than if it's just in an amorphous black hole with all your other savings.
Our colleague Gabrielle Monaghan did a piece on this, and it's funny the amount of people and friends that came to me afterwards who had read the piece and were just, they were kind of sickened because they wanted to do it. They had a plan and they didn't do it. And yet they still had really young kids. So I think the message is it's not too late. It's not something you have to start in day one, or in year 1 or 2 or 3 or 4. You can really start this at any age, right?
Of course you can. And as I say, lots of people don't do it until their kids are in secondary school and they're starting to come home with, leaflets about thinking about college and points and all that kind of thing. And parents suddenly go, gosh, we've nothing put aside for this now. And the student contribution, I mean, okay, that's 3,000 a year. That's the least of it, as you well know, because you're going to have all kinds of other things. And you don't want to be coming to your kid at that age and saying, by the way, good luck in your leaving cert and here's your study materials. And by the way, you can't afford to go to college anyway.
Yeah, you're on your own, kid.
Yeah, exactly.
Sinead Ryan, thank you so much.
Thanks, Katie.